Okay, let's continue. We are doing a how to design series on mutual funds. How to design a mutual fund, and this section is for a design by an engineer. How would a engineer design a portfolio? Okay, engineer has to go through a process, and this section discusses the process the engineer goes through. Okay, let's continue. And I'm Sarwan Agrawal. Let's continue. Let's continue with next section here. We already gone through first 7 sections, and next section is portfolio design by an engineer. So let's see how an engineer would design a portfolio. Okay, let's continue. So engineer's portfolio design. Okay? An engineer uses a method like decide on target allocation, and we have a 60-40 for this discussion. Okay? Research to identify candidate funds. So engineer needs to go through a process, and this process includes first decide on target allocation, then research to identify candidate funds. The next thing we do, run through inclusion exclusion filter. Engineer has to know when a fund is no good anymore, and that gives me exclusion filter, and that gives me a idea when to replace a fund. Let's continue. Analyze to select highly ranked funds. Then we have to go through analysis process and rank them and assign scores to various funds, and then select the highly ranked funds. Okay, so we're going to select a highly ranked funds. Okay, let's continue here. Then we synthesize that. Synthesis for optimized target allocation. Then we have to do a target allocation, which is 60-40 here. We will try to optimize the allocation. Let us continue. And then verify the risk reward back test portfolio, that what kind of risk I'm getting and what kind of reward, uh, what kind of risk I'm taking for what kind of reward I'm getting. Okay, let's continue. We do a back test the portfolio. Let's continue with the design here. Okay, it's a process. We start with research, then we go through filter. We do research for candidate to decide candidate funds, then filter them for inclusion and exclusion. Okay, let's continue. Okay, so research, we will build a list of candidate funds. Okay, then we'll use a filter to drop out some of the funds which failed the test. Okay, let's continue. Okay, then we'll score them to and assign a score to the fund. We get a scored funds here. Okay, let's continue from here. Okay. Then this section we have covered already, so we get the score funds come in here and they go through optimizing allocator. Okay, let's continue. So this is score fund, and we go through optimizing allocator. Okay, and in the end we have a optimized target allocation. Okay, so we would have a target allocation that meets our requirements and it's optimized in some sense. Okay, let's continue from here. Let's go discuss one at a time. So research, will do funds research. Okay, and then what do we do? Okay, so we look at the funds mentioned on AMP's morning start discussions. Okay, we'll do a look at one source fund from Schwab. Look at the fidelity picks. We'll do a various screeners results. We'll do a Morningstar funds compare tool for ideas, and we'll also use US news funds for ideas for candidate funds. Okay, let's continue from here. Then in the end we get in a candidate funds. Okay, let's continue. So research is, we look at all the sources of information which would give me a list of mutual funds to consider, and then we would look through research and use them for research, and we have a candidate funds. Okay, these are raw funds. These are total list of the funds we want to consider. Okay, let's continue. We start with the process analyze and score. Okay, and feed up with this thing with candidate funds. and then feed in stats alpha, beta, r squared. This is a modern portfolio theory stats. Then we feed into that returns and standard deviation, Sortino ratio, bear market percentile rank, upside market capture, downside market capture, tax efficiency. Note, analyze and score use these and other stats to assign score to candidate funds. This list is not exhaustive, and in future I might score the funds differently. And you should have your own mechanism too. Intent is to rank and use higher rank funds in building portfolios. Okay? So this process here, analysis and score, uses all these stats and maybe more, and result in a fund with score. Now we have a funds which have a score, okay, which we score we assign. Okay, let's now we are going to last process, optimizing allocator. Let's continue here. Our primary issue is to use selected funds to build a portfolio to match our constraints of US is 42%, non-US allocation is 18%, fixed income is 40%, large cap to mid cap plus small cap ratio is 3 within plus minus 10%, US non-US is 3 within plus minus 0.1. And what do we have? We have mutual funds. Most of these funds do not stay within the themes. There is asset bleed. You can get non-US exposure from US funds and vice versa. Similarly, you can get in a fixed income exposure from an equity fund. Okay, let's continue. Challenges and opportunities. They represent a challenge to create target portfolio. So if you do a shortcut type portfolio, we noticed that it was heavy on non-US equities and lean on the US equities. So, and that is because of all the bleeding that we ignored in a shortcut to portfolio. However, multiple choice. Let's continue. So we were talking about this section here. Multiple choice also present. Flexibility to get US, non-US fixed income, large cap, mid cap, and small cap from various sources. So multiple sources for all these my assets allocations. Okay, let's continue. Problem: find a target allocation from selected funds. So this is what we're trying to do, subject to constraints. So we're trying to find target allocation from selected funds and subject to constraint. First of all, there is asset bleed. Then the constraints are, most of the constraints are of inequality constraints, like x is less than y, x is less than equal to y, or x is greater than y, or x is greater than or equal to y. Okay? In such a situation, either constraints are unrealistic and no solution exists. So there is no way we can make a target allocation. There may be some conflicting constraints. Okay, when the constraints are realistic, we should have multiple solutions to achieve the target allocation. So we're not looking for exact solution. We are looking for a solution that meets these inequalities we have, okay, or our constraints. So in that situation, we should have either no solution or multiple solutions. Let's Okay, this is from previous slide here. From multiple solutions, one solution may be better than other solutions are. Okay? To determine that, we need to define how one allocation is better than another allocation. That makes our optimization metric. Okay? So one allocation portfolio is better than another portfolio. Okay, let's continue. And to find a better optimal allocation, engineer uses linear programming. However, it's a linear all the constraints are linear. Okay, however, that generates a locally optimal allocation. If you do a linear programming, I'll get a locally optimal allocation, and that allocation depends on the selected initial condition or starting gas. So a we would use a linear programming. However, there is that only gives me a local optimal solution, and I'm trying to find a global optimal solutions. and this solution depends on the selected initial condition. Okay, let's continue. So we have already talked about this section here. This is a repeat from the previous slide. Okay. For a global optimal solution, engineers use Monte Carlo simulations to find allocation from numerous initial gas values. After that, they select the best from all of the solutions. Okay. So we start with the multiple or numerous of the simulations, and then from each of the simulations, when there was a solution, we find out the best allocation given our optimization metric. Let's continue. I use homegrown allocator, which is proprietary tool for that. Next slide attempts to describe that too. Let's continue. So here's optimizing allocator. Okay, and selected funds go in. Okay, that's we need to have selected funds we are trying to use to achieve the allocation. Okay, then we pass an optimization metric in here. Okay, and when I find a superior optimization metric, I'll start using that. So I'm using a proprietary metric right now, which I believe is trying to determine a skill of the portfolio manager of a fund. So if I find a superior metric, I will start using that. Okay, let's continue. Then we add all the constraints here, and these constraints are for allocation, mitigating single point of failure, minimum required return, etc., etc. And this single point of failure is for larger allocation like large caps and fixed income allocations. We use multiple mutual funds to for in that space. Okay. We usually use 2-3 mutual funds for the large cap and a couple of funds for the fixed income allocation. Okay, let's continue. So that's our we're trying to mitigate a single point of failure. Any decent manager can have a bad year. So if I had multiple funds in the same space, we would mitigate some of the issues from a manager having a bad year. Let's continue from here. And when we all get beside these things up and allocation goes through its Monte Carlo simulations, I get a target allocation which is superior to other allocations and given the metric we use. Okay, let's continue. Now question is, how do I know that it's the best portfolio? Okay, answer, I don't know. Someone else might do it better. However, discipline beats emotion most of the time. So we went through discipline. We avoided the emotion. So it's we also did the hard work. In any case, our results depend on the use data, which is funds and stats we use, and assumptions I might have used sometimes. So it depends on our data, which is funds and stats and assumptions we might have made. Let's continue here. Can a portfolio designed by an engineer lose money? Answer, any investment can lose money. We assume, calculate risk and expect corresponding returns. However, no one knows the future and no one can guarantee a desirable outcome. So any investment is risk prone and we can lose money. Okay. Let's continue. We have history as a guide to indicate that equities generate 6.5% or so in excess of over inflation over long period of time. So equities generate about 6.5% or so in excess of inflation over long period of time. So we're counting on that history to repeat itself at least in the long run. Okay, let's continue. We will subject the portfolio through dry run. We'll go through dry run to see how it would have behaved during the past 10 years or so. Let's continue. What's a well-designed portfolio? So we're trying to design a portfolio. What is a well-designed portfolio? Okay, and so it's a tough question. It goes back to target allocation. A target allocation gives you risk-reward profile, and that's what we did with a passive uh, growth chart for a passive portfolio. Risk-reward profile. Okay. A design portfolio tries to achieve a superior return compared to the return of a passive portfolio. Okay. and lower risk given by standard deviation. So we're trying to get superior return and lower standard deviation. A well-designed portfolio should significantly improve the desirability quotient of the portfolio, which is return divided by risk. Return divided by standard deviation, we are trying to improve that. A well-defined portfolio should significantly improve desirability quotient of the portfolio, and that quotient is return divided by risk. Let's continue. A 60-40 engineer's portfolio. I use some constraints to enhance returns, and the tool produced the following portfolio. Okay. Oakmark 11.8% and IWIRX 35.41% and PRBLX is 7.10%. See that the most of the large cap allocation went through the IWIRX fund here, and this is a mid cap growth fund NICSX, Oakmark International, MGIBX 0.9%, and this is my bond fund allocation 38.93%. To allow the tool to optimize, we have to give it some slack. You can over specify the problem to the extent of no solution meets the constraints. So we have to give some slack to the tool so that it has some room to optimize. Okay, let's continue. So my optimizing tool gave me this allocation, which does, let's see if it doesn't meet our requirement. So US is for 2.16%, which we were looking for 42%. That's close enough. Non-US is 17.32%, and that's we were looking for 18%. And equities is 59.5%, which is nearly 60%. Bonds similarly are 36% for bonds and 3.74% for the cash, and which fixed income is 39.78%, which is nearly 40%. So 60-40 part matches. Now let's look at the ratios here. Large cap is 76%, mid cap is 21%, small cap is 3%. So this ratio, large cap divided by mid cap plus small cap, is 76 divided by 24, which is close to 3. The 75 by 25 is 3, and this is the one more than 75, and this is one less than 25. Let's say non-US to US is 42.16 divided by 17.32, which is 2.4342, and it is within a plus minus 0.1 of 70 divided by 30. So our ratios all match. We got a portfolio in which at least the ratios match, and let's see what the returns. Now this is the growth chart of this portfolio, and I got 187 months. It has data as of 12th August 2014, and the returns are 8.39% per year annualized basis, and the standard deviation is 11%, and Sharpe ratio was 0.58. Sharpe ratio assumes that a risk-free return of 1%, and it portfolio was reallocated yearly. Okay? Let's continue here. It has this my allocation here. Okay? Let's continue. Okay, here is the comparison. This is my portfolio, engineer's portfolio. Okay, right here, and this is the design. This is what we design in the class. Okay, which is, and this one is a shortcut. Okay? So out of these, which one is better? If you're looking for return, this one is better. If you're looking for a standard deviation risk, this one is better. So shortcut is better on risk, and the one we designed with a 60-40 and proper allocation to US and non-US is has a better return. And this one is a passive. Passive has a same kind of risk as that shortcut with shortcut portfolio is, but smaller return. Okay, and this is a Standard Poor's had a lot higher risk, and its return is better than the passive, but worse than the others portfolios we have. Okay. Let's continue. Okay, here's the data here, year by year, to 2005, 6, 7, 8, 9, 10, 11, 12. This engineer's portfolio, this is design portfolio class, this shortcut portfolio, this passive portfolio, and Standard Poor's. Okay, in 2005, the shortcut portfolio had the best return. Okay, and in 2006, Standard Poor's had the best too. Okay, and 7 engineers portfolio had best return, and passive was the second best. Okay, and in 2008, shortcut return had the best returns, and passive had second best, and Standard Poor's had the worst returns. Okay, so you look at this one here. So India's portfolio was best in 1, 2, 3, and 4 times. Okay, and was second best once and twice, second best twice, and the worst once. Okay, designed was never best, but it was second best twice. Shortcut was best twice and second best once. Passive was never the best, but second best twice and third 3 times. And worst was 1, 2, 3, 5 times. So passive was worst more often. Standard Poor's was best 1, 2, and 3 and 4 times, and worst 1, 2, and 3 times. Okay, so you see that in engineer's portfolio was down only worst only once. Okay, design portfolio was never worst, but never at the top either. Okay, shortcut was never worst, but was at top twice. Okay, and passive portfolio was never at top, but okay, and so on. Let's continue. And I know the engineer's portfolio had the better results, returns. Okay, let's continue. Let's continue. So before I added some constraints for enhancing the return, and my portfolio was Oakmark 9.8% and IWIRX 3.27%, PRBLX to 9.4%, and in NICSX 5.89%. Okay. Oakmark International 2.69%, MGIBX 10.77%, TGLMX 38.18%, and I would rather use DLTNX double line total return series N fund. Okay, let's continue from here. And the return as of that date, 13th August, was 9.34% per year as a standard deviation of 9.19% per year. Return was higher than the standard deviation is for 10-year case and was 60-40 portfolio. If I do a passive portfolios, and that is possible only for a 40-60 portfolio where 40% are stocks. So this we have achieved a higher return than this standard deviation with a 60-40 portfolio. In my opinion, that's superb. That's a great, okay? That's a great portfolio. Okay? So let's continue. But we're looking for returns, and then on return basis is not as good. Uh, Other portfolio generates a higher return. Let's continue. Okay, added some constraints for positions values. Adding minimum allocation constraints optimize now my allocate return this thing. Bookmark fund 12%. I ask it to give you at least 12%. IWIRX 12%. I ask it to give at least 12% of that too, and that left me PRBLX of 23.39%. Nucleus fund 5%. I ask it to give at least 5%, and so on. So that way, here I can make it look like more symmetric allocations. Nothing lopsided here. This is Oakmark 12%, IWIRX 12%, and PRBLX 23.39% ratio of. So this is 24% almost, and these two are 24%. Similarly, Nucleus fund has smaller allocation, and just say give me at least 5%. So I can specify those constraints also. And the 10-year return was 9.53% at a standard deviation of 9.57%. 9.53 and 9.57 are close, nearly equal, and that's a great portfolio. Okay, too, because its standard deviation has not gotten out of hand yet. And the simulation, these results are from this simulation as of 12th August 2014. Okay, let's continue. So let's give some notes here. To optimize portfolio, we can not over specify the problem. We need to leave some slack. That's the only way the optimizing tool can optimize. My initial portfolio was marginally better in returns and far superior in standard deviations. So when I did not added any constraints for return, that was a marginally better in return and far superior in standard deviation. And that portfolio won by not losing much. This is how that portfolio won, by not losing much, which is superfluous allocation. That's the way we need to go. That do not lose the money. That this portfolio followed do not lose the money principle. Initial portfolio had a return higher than standard deviation. We have talked about that. To extract high return, I added constraints to deliver high return. So I added some constraints to deliver high return, and that also increased the standard deviation. Okay? And it did not hold that well during 2000 crash. My initial portfolio had held up pretty well during crash, and this one did not hold that well. And here the results are: if you change the returns, higher standard deviation will follow too. So high returns and high standard deviations go hand in hand. Let's continue from here. Okay, we have gone through this process. It should have added some value. All these efforts add value to the design portfolio. First of all is I get a lot better allocation to the target. Our portfolios are matched a lot better with the target than any other portfolio that you can get to using a shortcut method. We do use a spirit fund. We go through serious research to locate superior funds. So that also adds some values, and we only keep the high ranked fund. That also adds values. So allocation adds value, and then after that we also optimize. That also adds value. So these portfolios we have been adding values at every step here. Okay, let's continue. So this is a value added superior portfolio when we get out of using all the enhancement processes. When you try to do the best you can at every step, in the end you get a superior result. Let's continue. Okay, the stats of the all the portfolio we discussed so far, and the data in this stats is as of 13th August 2014. Okay, I have returns here, I have standard deviation, I have return, standard deviation, and IR, okay, which is information ratio. Okay, let's see what's going on here. For the best returns I have, these are for the engineers return enhanced portfolio. 16.70% for 60/40 portfolio for 3 years per year, and 13.84% for 5 years, and 10.09% for the 10 years. Okay? And the worst returns are for the passive portfolios. Okay, let's look up this. Yeah. Okay, here's the second best returns are of the design portfolios for 3 years and 5 years. Okay, and on 10 years, it's this portfolio here of the engineers constraint portfolio had a second best return here. For IR values, engineer enhanced return portfolio had the best IR values too. Okay. Okay, let's continue here. Let's see now. We already know what return is, standard deviation is. We just don't know IR, and that's discussed on the next slide. Let's continue. Okay. So standard deviation in percent per year and is computed from monthly return values. Okay. And return is investment return in percent per year and is annualized. Okay. And IR is information ratio, which is normalized outperformance. For the purpose of IR, outperformance is from relevant index, which would be passive portfolio in our case. And normalization is with respect to standard deviation of the portfolio under consideration. Okay. So this is the IR. Okay. Okay. And you may use online search for more information. A value of 0.25 for IR is good. 0.50 is very good. 0.75 is expert level, and value of more than 1.0 is exceptional. For 3 years, we have a 0.58, which is more than very good, and for rest of them, we have a more than 0.25, which is between good and very good. Okay. Let's continue. Okay, let's go some summary and hints. And these are my parting thoughts. And let's see, we start from your broker side. Keep it simple, okay? Because you can go find a mutual fund that's not available. So if you start from your broker side, then you know the fund is available. Consider funds for load, fees, availability, and minimum investments. Okay, pick funds for superior star ratings, long history, and superior returns. Okay, let's say you need three funds and you pick up seven, then you can rank them. Rank funds and go do the easiest you can do. Use a Morningstar Funds Compare tool or US News mutual fund site, or you can go take the hard way out also. You can do harder way, but these you should do most of the times. Check out construction of each selected funds from X-ray tool. Okay? So Morningstar X-ray tool, and you can use allocation spreadsheet. We use an X-ray data to achieve target allocations. So you can use, first we know that how much our US is, how much non-US is, and how much is fixed income allocation is, what's the ratio of large cap to mid cap and small cap allocation. Yes, so use all that and X-ray data from the funds to achieve a target allocation. Now you have portfolio you can be proud of. Okay? And we try to use three funds for large cap. You feel free to use fewer funds. Okay? Because if your portfolio is smaller, too many funds do not make sense. Okay? And sometimes allocation funds and fund of funds are appropriate in some portfolios. Here is a allocation fund which I have used in the past. It's a Willx fund, VILLX. It's a 65-35. It used to be 60-40 fund. Okay? It says US only allocation. And here is a Vanguard Star fund, which is fund of funds. It's last time I checked recently was 60-40 fund, and it has US, non-US, and fixed income. It was heavier on the non-US side and lean on the US side. The ratio was, instead of 60-40, it was 64-36, I think, 64. Instead of 70-30, it was 64-36. For the US to non-US ratio was 64-36 instead of 70-30 we have been using here. So it's very similar to 60-40 portfolio. So if you had only $1,000 to invest, you get a decent portfolio with just one fund, Vanguard Star Fund, and keep it simple. Okay? So I know we had three large cap funds, two international funds, and two bond funds, and in my personal portfolio, I use a fewer funds. Okay, so keep it simple. Let's continue, and that's it. I sure hope you have a great investing experience, and I sure hope you learn something that you can use.